All right, everyone. Before we begin, I want to note that this guide was prepared for our course by Dr. Samir Al-Rishiani with some AI support.
So, welcome. In today's session, we're going to do a deep dive into a really important and honestly often overlooked savings vehicle in the Canadian tax system, the Registered Disability Savings Plan, or as we'll call it, the RDSP.
Let's kick things off with a big picture question, one that really gets to the heart of why this plan even exists. How can we, as a society, use our tax system to help build real, long-term financial security for Canadians with disabilities?
And the government's primary answer to that question is the RDSP. It's a savings plan with one very specific goal: to help people save for the long term. But, and this is the most important part, it is only for individuals who are approved for the Disability Tax Credit, the DTC. That approval is the key that unlocks this entire program. It's non-negotiable.
Here's our game plan for today. We'll start with the basics, what an RDSP is. Then we'll get into the exciting stuff, how money gets into the plan through contributions and some amazing government help. After that, we'll cover the investment rules, how payments work, and finally, we'll wrap up with some special situations you absolutely need to know about.
Okay, let's jump right into Section 1. Before we can talk about contribution limits and grants, we have to understand the ground rules. Who can even have one of these plans, and how do you get one started? So, who can be a beneficiary? Well, there are 4 key boxes to tick. First, as we've already said, they must be approved for the Disability Tax Credit. No DTC, no RDSP. Simple as that. They also need a valid social insurance number and have to be a resident of Canada. And finally, there's an age limit. The plan has to be opened before the end of the year in which the beneficiary turns 59. All right, now for the really exciting part. This is where you'll see why the RDSP is one of the most powerful savings tools out there. It's not just about what you put in, it's about the incredibly generous government grants and bonds that go in with it. First up, private contributions. Pretty much anyone, family, friends, you name it, can contribute to an RDSP, as long as the plan holder says it's okay. There's a lifetime limit of $200,000 per beneficiary. But here's the crucial detail. That $200,000 limit is only for private money. The government funding we're about to talk about, that's completely separate and gets piled right on top. And this is where things get really incredible. It's the Candidate Disability Savings Grant, or CDSG. Just look at those matching rates. For families with an income under about $111,000, the government will match the first $500 you put in at 300%. That's right, 3 to 1. Then they'll match the next $1,000 at 200%. So you put in $1,500 and the government adds another $3,500. It is an absolutely extraordinary incentive. But believe it or not, it gets even better. For lower income families, the government also provides the Canada Disability Savings Bond. And the key difference here? No contribution is required. This is free money. If the family's income is below about $36,000, the government just deposits $1,000 into the RDSP every single year. So what happens if someone was eligible for years but just never opened a plan? Did they miss out? Well, no. And this is another brilliant feature. Unused grant and bond entitlements don't just vanish. They can be carried forward for up to 10 years, which means a beneficiary can play catch-up. Let's make this real with a quick case study. Meet Roger. He's been eligible for the DTC for a long time, since 2008, and has had a consistently low income. But he only gets around to opening his RDSP in 2024. Because of the carry-forward rule, he can now access all the entitlements he missed over the past 10 years. And look at the immediate impact. Just by opening the plan, Roger's RDSP gets a deposit of $10,000 in accumulated bonds. $10,000, just like that. And now look at his grant room. When his family puts in just $800, it gets matched at that highest 300% carry-forward rate, netting him a grant of $2,400. This carry-forward provision isn't just a small detail, it is an absolute game changer. Okay, so we've got the money into the plan. Now let's talk about managing it. What are you allowed to invest in, and how do other registered plans like RRSPs or RESPs fit into the picture? So the rules are pretty flexible, but they're also designed to prevent any funny business. On one hand, you can hold a wide range of qualified investments, things you'd see in an RSP, like cash, GICs, stocks, and bonds. But on the other hand, there are some big no-nos. Prohibited investments are all about stopping self-dealing. You can't, for example, lend money from the plan to yourself or invest in a private company you have a big stake in. And trust me, the government is not messing around here. If you break these rules and hold a prohibited investment, the penalty is severe, an immediate 50% tax on its fair market value. That's a huge deterrent to make sure these plans are used exactly as intended. All right, we've covered getting money in and how it grows. Now let's tackle the other side of the equation. How does money come out? These withdrawals are called disability assistance payments, or DAPs, and they come with a very specific set of rules. Once a beneficiary hits age 60, they have to start taking out what are called lifetime disability assistance payments, or LDAPs. The maximum amount they can take each year isn't just a random number. It's calculated using a very specific formula, right from the Income Tax Act. Now, don't let the algebra scare you. It's actually pretty logical. A is just the market value of the plan. The part at the bottom, B plus 3 minus C, is basically a life expectancy factor. B is either 80 or the beneficiary's age, whichever is higher, and C is their actual age. The whole point of this formula is to spread the payments out and provide a steady income stream for the rest of the beneficiary's life. Let's plug in some numbers to see this in action. Here's Paul. He's 59 at the start of the year, so he's about to turn 60 and has to start his LDAPs. His plan is worth just over $261,000. We pop those numbers into the formula, and it tells us his maximum withdrawal for that year is $10,893.67. And for our final section, we need to cover some really important what-if scenarios. Since the government puts so much money into these plans, there are rules about what happens to that money if you take funds out early or if the plan gets closed. Now, this is a critical change in the rules that you have to understand. The old rule, the 10-year rule, was pretty harsh. If you made any withdrawal, you had to pay back all the government grants and bonds you'd received in the last 10 years. Ouch. The new proportional repayment rule is so much better. Now, for every $1 you take out, you only have to repay $3 of the grants and bonds from the last decade. And this example shows you just how massive that change is. Meet Jeff. He's got $21,000 in government funding from the last 10 years. He just needs to take out $600 for an expense. Under the old rule, that $600 withdrawal would have triggered a clawback of the entire $21,000. It was devastating. But under the current rule, he only repays $1,800. This makes the RDSP a much more flexible and accessible source of emergency funds. So to wrap things up, the RDSP is, without a doubt, an incredibly powerful savings tool. The level of government assistance is basically unmatched. And that leaves us with a practical question for all of you. As you head out into your careers, how do you advise a client to strategically use this unique plan? How do you balance it with other tools like a TFSA or an RSP to build a complete financial picture? That's something to think about, and we'll pick up on it in our next session.